Hi, we're going to be working on exercise 13-3, which deals with both horizontal and vertical analysis of the income statement. If you haven't either read chapter 13, watched the mini lecture on horizontal and vertical analysis, or done the concept overview video, please stop this video, go back and do one of those three things, and then come on back and watch the problem itself. So this chapter is about measuring and evaluating financial performance. It's really important to do all three types of analysis, horizontal, vertical, and ratio analysis, to be able to get a good idea of how well a business is doing. Let's first review briefly what horizontal analysis is. Horizontal analysis is looking for important financial changes that unfold over time. So sometimes it's called trend analysis as a result. And the math here is very easy, but the value lies in the interpretation of the facts. Once you identify significant changes or trends, you then investigate, and that's where you learn about the company. So what we do here is we look at at least two financial statements. So we call these comparative financial statements because we have more than one. The most recent year is listed in the first column. The earlier year is in the column to the right. We subtract, so 100,000 minus 120,000, and the difference is a decrease of 20,000. Now, in the real world, we would put parentheses around these to show a decrease, but in Connect, when you put a minus in, Connect will change it to parentheses. So that's the dollar change. And we do that with each one. 60,000 minus 71,005 is minus 11,500. 40,000 minus 48,005, a minus 8,500. And so on with each of these. Now, if we look at selling, general, and administrative expenses, if we look at interest expense, it actually went up from 2015 to 2016, so that was an increase of 25, so we would not put a minus sign then. Let's finish these up. Subtracting each one. So there has been a decrease as we move from 2015 to 2016. So when we put in our calculator, 100,000 minus 120,000, we get a minus 120. So in each of these cases, we're subtracting, and the answer goes in the column labeled dollars. And you can label it just as it is in your calculator. If there is a decrease as we move from 2015 to 2016, you put a minus. If there's been an increase, you leave it as a clear figure. So now we know the change in dollars. Let's find out the change in percents. What we do now is we take the change in dollars and divide by the earlier year. I'll write this one down here. 20,000 divided by the earlier year, 120,000, and that will give you a decimal. So we multiply by 100 to change it to a percent. And if there's been a decrease in dollars, we also have to show it as a decrease in percent. So after we do this, we then round it to one decimal place, so that becomes 16.7%. And because we have the word percentage here, we won't bother putting the percents on each line. See if you can do that mathematically and if it works out on your your calculator. 20,000 divided by 120,000, multiply it by 100 to change it to a percent, and then round to one decimal place. And we do that with each one. 11,500 divided by 71,500, multiply by 100, and round to one decimal place. 16.1%. 8,500 divided by 48,500, then multiply by 100 and round to one decimal place, 17.5%. And we do the same for each one. Now when we get to interest expense, because it went up, $25 was an increase, we divide that by 475, multiply by 100 and round to one decimal place, that's 5.3%. And just the way we did not use a minus or parentheses in front of the dollars, we will not do so in front of the percent either. Income before income taxes, 7,525 divided by 11,025 multiplied by 100, round to one decimal place, that's a minus 68.3%. Income tax expense is an even 80%, and net income is a decrease of 58.5%. And again, because they have the word percentage up there, I'm not writing the percents in here. Okay, so what are the significant differences or changes? Well, we see that sales revenue went down 16.7%, but the cost of what we sold does not go down as fast as sales. So consequently, your gross profit drops at even a faster rate. Your selling general administrative expenses went down, but not as fast as the sales did. Our interest expense went up, so perhaps we had to borrow money because we've been in some financial difficulties. Income tax will go down when your income goes down. And overall, net income went down 58.5% between 2015 and 2016. So Computer Tycoon is not doing very well. Now let's take a look at vertical analysis. Now what we do is we stay within each year's income statement as we use vertical analysis. With vertical analysis, we're looking at important relationships between items on the same financial statement. On the balance sheet, we would be dividing everything on the balance sheet by total assets. But on the income statement, we're dividing everything by net sales revenue, or in this case, by sales revenue within that year. So let's do that. For 2016, we're dividing 100,000 by itself, and then we multiply by 100 again around to one decimal place. In fact, let me put those directions right here. Divide all amounts, and this is important, within the year. Stay within the same year. By the net sales amount. In this case, it's sales revenue amount. Then multiply by 100 and round to one decimal place. So let's do that. In this, I'm just going to write on the side here, 100,000 divided by itself times 100 and rounded to one decimal place is 100%. 60,000, we'll go down to the next item, 60,000 divided by 100,000. Oh dear, I skipped a few zeros there. And then multiply by 100, round to one decimal place, is 60%. 40,000 divided by 100,000. Then multiply by 100 and round to one decimal place is 40%. Every single one of these items get divided by the sales revenue in this case, and then multiplied by 100 and rounded to one decimal place. Interest expense of 500 divided by sales revenue of 100,000, then multiply it by 100 to change it to a percent, and round to one decimal place, 0.5%. We do that with each item. Okay, and we stay within the year. Now we go to 2015, and we do the same, except we divide every item in 2015 by the sales revenue in 2015. So 120,000 divided by itself times 100% to change, or I'm sorry, times 100 to change it to a percent is 100%. You'll notice the sales revenue on an income statement will always be 100% because we're dividing by itself. 71,005 divided by 120,000, multiply it by 100 to change it to a percent, round it to one decimal place, and that's 59.6%. 48,500 divided by 120,000 gives you a decimal, multiply it by 100 to change it to a percent, and round to one decimal place, 40.4%. 37,000 divided by 120,000 gives you a decimal, multiply by 100 to change it to a percent, and round to one decimal place, 30.8%. And we do the same thing with each item, divided by 120,000, and then multiply by 100 to change it to a percent and round to one decimal place. Oh, I put a percent there. I shouldn't have done that since I didn't with the others. 5,000 divided by 120,000 gives you a decimal, multiply it by 100 to change it to a percent, and round to one decimal place. And finally, 6,025 divided by 120,000, that gives you a decimal. Multiply it by 100, change it to a percent, and then round to one decimal place. Now, when we were just talking on the earlier video in the mini lecture, I said that when we use our income statement or balance sheet with vertical analysis, the math has to work out with the percents just the way it works out with the dollars. So when we take sales revenue in dollars and subtract out the cost of goods sold of 60,000, we get 40,000. The same thing with the percents. 100% minus 60% is 40%. And then if we take gross profit and subtract the two expenses, 40,000 minus 36,500, we get 3,500, just the way 40% minus 36.0 minus 0.5 is 3.5. So the math has to work out with both balance sheets and income statements. So let's take a look now at some observations we can make. In 2015, the cost of goods sold was 59.6% of every sales dollar. It rose to 60% of every sales dollar. In other words, it rose 0.4%. So costs were going up as a percent of every sales dollar. The gross profit then went down as a percent of every sales dollar. It went down by 0.4. As a percent of every sales dollar, the selling general administrative expenses went up. Now, in real dollars, they went down from 37,000 to 36,000. But as a percent of the sales dollars in each year, it rose from 30.8 to 36.0. Why did that happen? Well, there are some types of expenses that will not go down when your sales go down. For example, your rent. You're still going to have to pay the same rent, or property taxes if you own the property, and that won't change even though your sales may be dropping. You'll learn in Accounting 117 that those are called fixed expenses. Some expenses do go down when sales go down. Might be sales supplies or commissions if your employees work on commission, but there are some expenses that will be the same regardless. So Computer Tycoon is not doing well. In horizontal analysis, we saw that there had been a 58.5% drop in net income, and as a percent of every sales dollar, it went from 5% to 2.5% of every sales dollar. And that's it for our example of horizontal and vertical analysis. You can move on to the next mini lecture, or you can try the homework problem that's just like this one.